Alright, so now we're going to talk about the factors that you need to know before you buy a call option. First, what is a call option? Well, a call option is the right to buy. Specifically, it gives the buyer the right but not the obligation to buy a specific stock at a specific price on or before a set date. When we're looking to buy a call option, the first thing we need to look at is the strike price. Now let's say, for the sake of the example, XYZ stock is trading at $50 a share. Alright? So we could look at different strike prices, make that a little cleaner, for this stock. So let's say we're going to look at the strike prices of the 50 and the 55. Now remember, if we're going to buy a call option, we're bullish. We think the stock is going to go up. So if we bought the 50, that would be referred to as at the money because it's the same as the stock price. So we're going to say this option has 30 days of time, and let's say in the next week the stock goes up to $55 a share. It went up. We would have the right to buy it at 50. So we would take a $5 per share profit. Now we could also have chosen to buy the 55 strike price. Then what that would do is that would give us the option to buy the shares at 55. So if the stock went up to 55, we could buy them at 55. There's no profit there. But if it went up to 56, then we could buy it at 55. We'd have a $1 a share profit. Now, why would we choose one strike price over the other? Well, the closer to the money, the more expensive. So the at the money, let's say in this example, is $2 per share. An option contract is for 100 shares, or $200. So this would be $200. And the 55, let's say, is going for 25 cents a share, or $25, because it's further out of the money. So you would buy out of the money. It's much cheaper. You could potentially buy more options, but the stock would have to make a bigger move fast for it to be profitable. So it's a lot more risky to buy out of the money options. But you can buy more of them. So if the stock, went from 50, earnings came out, they were really good, they had really good guidance, and the stock shot up to 58 instead of 55, you bought the 55, you could buy the stock for 55 cents, sell it the next day on the open market. So, what's the maximum risk from buying call options? Well, the maximum risk is the premium that you pay for the option. Conversely, the maximum profit on buying a call option essentially is unlimited. The stock theoretically could keep going up and up and up. So the profit on buying a call option is unlimited. Now, so how do you profit from a call option? Well, you profit when the stock goes up, like we explained, but one thing I want you to understand is, say we bought the $50 strike price. We bought the at the money strike and we paid $2 a share, or $200 for that option. The stock goes up to 55. So we have the option to buy it at 50. So we buy our shares at 50, and then we sell them on the open market for 55. So that looks like we made a $5 per share profit. But you have to subtract the premium that you paid for the option. So your profit would be the $500 minus the $200 premium you paid for $300. So that's basically how a call option worked. Now, if you liked this video, please go ahead and click like below and share. And if you would like a stocks trading strategy that's profiting right now, click on the link above and I will email you a free video training I did on a strategy that I believe is the easiest way for anyone to come into the stock market and start making money. So click on the link right up in the corner, enter your email address, and I will email you the video.